Good afternoon, everyone, and welcome to our webinar, Farm Income and Financial Forecast for 2016. My name is Nancy McNiff, and I will be your host. The webinar is being recorded and will be posted on the ERS website. I put in the chat feature the URL where it will appear at a later date. At any time during this webinar, you may enter a question into the chat feature at the bottom left corner of your screen, and our speaker will answer your questions at the end of the presentation. Our speaker today is Jim Williamson. Jim is an economist with the Farm Economy Branch of the Economic Research Service. He leads the agency's Farm Income and Wealth Statistics program. Previously, Jim has served as a senior economist on the Council of Economic Advisors in the Office of the President. I think we're ready to start. So Jim, you can now begin your presentation.
All right, thank you, Nancy. Welcome to everybody. My name is Jim Williamson, and I will be presenting the Farm Income and Financial Forecast for 2016, the November update. All right, so let's get started. So in summary, I'd like to present some top-level information. So net cash farm income and net farm income are both forecast to decline by double digits. Net cash farm income is down 14.6% over 2015, and net farm income is down 17.2%. The value of agricultural sector production, again, is forecast to fall, and this would be the third straight year. And this is due largely to declines in animal and animal product cash receipts, but also related to a drop in farm income-related farm-related income. That would be income sources like grazing, machine hire, custom work. Government payments are partly offsetting the decline in cash receipts. So we have a rise of 19.1% or $12.9 billion, up to a total of $12.9 billion. And this is driven by primarily by increases in PLC, up about 160%, and agricultural risk coverage, which is up nearly 36%. Total commodity insurance indemnities are forecast to fall, and this is largely on a decline in the federal crop insurance, or FCIC insurance indemnities. And this is due to a general decline in the quantity of insurable losses. Also contributing to net cash income is the total production expenses, which are forecast to decline 2.6%. So this is again a year-over-year fall in production expenses. Finally, declining farm sector assets are offsetting the rise in debt. So we have an erosion of equity of about 3.1%. So we last gave our farm financials report in August, and given this is an update, we want to let you know how things have changed since then. We get this question a lot. So in August, we had net farm income at $71.5 billion. This November update, we have net farm income at $66.9 billion. And so we wanted to give you an idea of what has changed since then. So keep in mind that this newest update for November incorporates the November WASDE price and quantity information. We also have new monthly marketing patterns that we've incorporated into this latest farm income update. So the primary drivers of the change over the August 2016 net farm income number are crop receipts, which are up $4.2 billion. But this is offset by a decline in animal and product receipts. So those are down $4.7 billion. Cash expenses were a little higher than we had forecast in August. They're $0.9 billion higher. So that's also contributing to the decline. So ultimately, we have a $4.6 billion difference between the November 2016 forecast, net farm income forecast, and the August 2016 forecast. Now moving to net cash farm income, we're expecting to see it fall again to the lowest level since 2009. So net cash income is a measure of the farm's resources, the ability to pay down debt and to make investments. Net cash income includes CCC income, commodity insurance, direct government payments, as well as other farm income, for example, custom work and hiring. And this is all less cash expenses. So we forecast net cash income down nearly 15%. And this follows a 20% decline in 2015. So I think one thing to recognize is the direct payments act as a counterbalance, and so we see direct payments, government direct payments, increasing as other farm income declines. So for 2016, the government payments make up about 14% of net cash farm income. So net farm income, which includes net cash income plus non-cash income, for example, the imputed rental value of the dwellings, as well as non-cash expenses, and this would be is primarily made up of capital consumption, or what we use as a proxy for depreciation. Net farm income is dipping as well, and net farm income is forecast at $66.9 billion for 2016, and this is down 17% over 2015. Now, again, we like to show how we're getting from our 2015 net farm income to our 2016 forecast. So in 2015, we forecast, or the number, net farm income number was $80.9 billion. And again, once again, the forecast for 2016 for net farm income is $66.9 billion. So that's a $14 billion difference. And this is accounted for primarily by a decline in livestock receipts. So that's down $23.4 billion. And this comes on nearly across the board declines in all types of livestock receipts, save turkeys, which are up. Crop cash receipts on the left side are up marginally, essentially unchanged over 2015, but this masks a lot of variation. Soybeans are up, but corn is down, and as are many of the other grains and crops. Production expenses are down, which is contributing to a little bit of a growth in that farm income. So they're down over 2015 by $9.2 billion. And finally, government payments are up $2.1 billion over 2015. Now we'd like to give you an idea of what's accounting for this change in cash receipts. The question is it a price change or is it a quantity change? So we're providing an illustrative exercise where we would hold either the price in 2015 constant or the quantity in 2015 constant to arrive at a 2016 forecast. So if we were just to change the prices for 2016 and hold the quantities at their 2015 level, we would see a decline in cash receipts of $41.3 billion. Conversely, if we were to hold prices at the 2015 level and change the quantity to the 2016 levels, we would see a rise of $17.5 billion. So in sum, cash receipts are down $23.4 billion, and the main driver is the price, total commodity prices. So breaking out cash receipts by crops. So as I mentioned, crop receipts are forecast down for nearly all crops, save soybeans. And since soybeans represent such a large portion of crop receipts, nearly 20%, a little bit more than 20%, we have a net overall change that is very small but positive. So corn is down over its 2015 number. while cotton is up slightly. Fruits and nuts have fallen, vegetables and melons down, and so is wheat. On the livestock or animal and animal product side, we have animal and cash receipts down overall of 12% over 2015. All major categories are seeing declines, and this is led by cattle and calves, as we marked here. So egg production has recovered over 2015, and prices have dropped off precipitously, and therefore we see a really large drop in chicken egg prices. So government payments, as I mentioned, they're making up more than 14% of the cash income to the sector for 2016, and this will give you an idea of the mix of types of programs that are accounting for that. So again, government payments are forecast to increase by 19% to a total of almost $13 billion in 2016. So as you can see, the price-related programs are really accounting for most of that in 2016. Now, I'd also like to mention that the number in 2016 is inclusive of about $300 million in the cotton ginning cost share program, which is new for 2016. Federal commodity insurance indemnities also make up farm income, and for 2016 we're forecasting federal insurance indemnities to be down over 2015, while the premiums that the farmer pays are up slightly. So we have them rising by about 1.2%. The premium payments 1.2%, which is about $3.7 billion. Moving on to the farmer's costs. So the big story is that the total production expenditures are forecast down 2.6% overall. So we'd like to point out that it's fairly rare to see expenses decline year over year. So we have 2 years in a row where we've seen production expenditures falling, and this hasn't happened since the 80s. And so what we presented here is a time series of total production expenditures back to 1970. So what we can see here is that expenditures grew by about 8% annually between 2010 and 2014, and now we've seen 2 years of declines. We'd also note that in real terms, total production expenses are still high relative to the 1970s, 1980s. Breaking out the farmer's costs a little bit more, we have a chart of total expenditures by the type. So first two categories, feed and livestock purchases, are farm origin. So these are produced on the farm. So you can see livestock purchases are down, and this is a reflection of falling cash receipts for livestock. Feed is up a little over 2015, and this is accounted for by a change in an increase in livestock inventories. Fuels and oils and fertilizers, which are derived from natural gas, and, are both down. So these are following the market trend for petroleum. Pesticides and seeds, again, so pesticides are up a little, seeds down a little over 15. Net rent to the farmer is down slightly. So net rent is inclusive of cash, any cost shared between the farmer and the landowner, and so it's ultimately down a little bit. Interest expenses are down as well. On the other hand, labor expenses are up following the general increase in the wage index. On the balance sheet side, we see what we present you here is inflation-adjusted numbers. So the value of assets is forecast down 3.4% relative to 2015. So this is on falling land values, as well as a lower value of machinery and equipment that's held. The inflation-adjusted value of farm real estate is forecast up 7.1% though. Non-real estate, debt. Non-real estate debt forecast down about 0.1%. Okay. Turning to some financial ratios. So if you want to look at the consider the solvency of the sector, the debt-to-asset ratio and the debt-to-equity ratio would give us an idea of the sector's ability to meet payments in the face of some kind of crisis. So the debt-to-equity ratio and the debt-to-asset ratio have been ticking up. So for the fourth straight year, both of these are forecast to rise. We'd like to point out that going back to 1970, these ratios are relatively low compared to the past, so to the 1980s, 1970s. So while they're both ticking up, we still see them relatively low. Moving from the sector to the farm business, we'd like to present a little bit of information at the farm business level. So farm businesses, by our definition, are operations with greater than $350,000 in gross cash income, plus those operations who don't meet that gross cash income threshold but have a principal operator who's a farmer as a principal occupation, as a primary occupation. So as you can see from the chart, the red plus the blue bars are the farm businesses. So the farm businesses make up a slight minority of all farms, but as you can see, they hold the vast majority of value production, a majority of assets, as well as a majority of debt. So that's why we're going to focus on the farm business going forward here. So I'd like to present the net cash income of crop farm businesses first. And so what this is telling us is the average net cash income. So again, this is receipts plus government payments, indemnities, CCC payments, loan funds, minus cash expenses. So as you can see for the crops, we have crop farm businesses actually improving over 2015. So a mixed grain farm business is up to an average of $198,000 in average net cash income. Wheat farm businesses are up, as well as corn and soybean. The only farm business that we have down are specialty crops, and so these are farms that employ a lot of labor. They also use a lot of water, so their expenses are moving higher overall. On the livestock side, again for farm businesses, average net cash income is down across the board for these farm businesses. So we have cattle and calves. The average net income for a livestock farm specializing in cattle and calves is $39,000. Dairy on the right, $165,000 in net cash income. So the primary driver for these changes in livestock are prices. So commodity prices are driving them lower. The net cash, the receipts are down, resulting in lower net cash income. So for dairy, in particular, down 25%. This map will give you an idea of how the impact of how the impact of the regional distribution of farming patterns, cropping patterns, production is affecting different regions. So for example, as we just saw, the livestock net cash income is down nearly across the board. So we have the Basin and Range down 15.1%. This is an area that would specialize in cattle, livestock. The Northern Crescent down 9.5%. This is driven by dairy, the declines in dairy. On the other hand, the Heartland is up 4.1%, and this is on the strength of soybeans. Mississippi Portal up 11.8%. Again, this would be on the strength of cotton and rice. Now looking at the solvency of farm businesses, digging into it again, we'll look at the debt to asset ratio. And so we like to point out that nearly 90% of crop farm businesses have a debt to asset ratio that's lower than 0.4. So these are farm businesses that we would look at as in a healthy territory. We like to point out though that there are some farms, for example, highly leveraged farms, which are farms with a debt-to-asset ratio between 0.4 and 0.7. That number is 6% for crop farms. Extremely leveraged farms, which are farms with a debt-to-asset ratio of at least 0.7 or greater, has been creeping up. This percentage has been creeping up since 2011 and stands at nearly 5%. On the livestock side, we see that there are the same picture. We have extremely leveraged livestock farms, like the crop counterparts, have been creeping up recently and stands at nearly 5%. The share of highly leveraged farms has been relatively stable at close to 5% as well. So finally, we'd like to talk about the farm household. So this considers the entirety of the farm household, the farm business plus earnings from off farm, and gives us an understanding of the well-being of the farm household. So the contributions that income from off farm work plus farm work and farm income have on the household. So pointing out that most farm households get a majority of their income from off-farm sources, we see that there are, for the median farm household, off-farm income has actually increased over 2015. So in 2016, we have a forecast that the median farm household will have off-farm income of $69,000, nearly $69,000. Total household income for the median farm household then is about flat over 2015, so it stands at $76,839. So finally, I'd like to leave you with some key reference data that you can, just to remind everyone where we stand. So for 2016, for November, the forecast for net farm income is $66.9 billion. And net cash income, $90.1 billion. Total sector equity is down over 2015. It stands at $2.5 trillion. Total household income is up slightly for the median farm household at $76,839. So that concludes the farm income forecast webinar for November 2016. I'd like to remind you that our next forecast for 2016 will be in February 2017, February 7th. And at that time, we'll also present our first farm income forecast for 2017. And thank you. I'd like to answer any questions I can.
Okay, thanks, Jim. Now, if anybody has any questions, you can enter them into the chat feature, and I will relay the questions to Jim. We have our first question, What is the difference between an estimate and a forecast of farm income?
Okay. Well, let me say first we produce in-year forecasts. So for 2016, we would only produce a 2016 forecast. Our estimates are set about a year and a half after the year is concluded, the calendar year is concluded, and this is a result of essentially a lag in our data. So the forecast the forecast is essentially what we're predicting that year will be, given that we don't have the information there. So we just set an estimate for 2015 in August of 2016, and this was based on the data that had become available.
Okay. Another question, when you use the term income, is that gross sales, net sales, or gross profit?
Okay, so we use a couple of terms for income. There's net cash income. So net cash income includes cash receipts from the farm. It includes other farm income. That would be money from custom work, grazing fees that they earn. It would also include government payments. So that net cash income is inclusive of government payments, farm insurance, commodity insurance indemnities, as well as CCC loan funds. Net farm income is net cash income less cash expenses, less non-money expenses, plus non-money income.
Okay. We have another question about the drop in livestock receipts. Do you know what is driving that, and is there any expectation for that to improve moving forward?
The drop in livestock receipts is driven by price. So we're seeing a drop in the price is driving the drop in cash receipts for livestock.
Okay, and we
don't have a prediction for what's going on forward. We'll wait for new price information from WASDE.
Okay. There's another question about the increase in total debt from August. They say they noticed a substantial increase in total debt from the August forecast, but there's relatively little change in the interest expense. Also, the 2016 interest expense declined from 2015. Can you explain why that is, or talk about that?
Well, since August we have gathered new information. So we have new information on loan quantities, and so that's what's driving the update. So the distribution of types of loans as well as the loan quantity is what's changing it.
Okay. How many, in number terms, do you know the number of crop and livestock businesses that are considered highly leveraged versus the percent? They're looking for the number of businesses. Do you have that?
I don't have that at hand, but if the person with the question leaves an email or address, we could get that number, I think.
Okay. All right. Let's see. Based on early indications, does 2017 look like the fourth straight year of decreases, or will the income go up, or is that too early to say?
For us, it's too early to say. We currently only have a forecast for 2016.
Given that commodity, I guess the question is really, why are feed prices up? Do you have any indication as to why they're up?
Yeah.
Given commodity prices.
That's correct. Feed prices are up based on higher livestock inventories. So remember, the feed price is a function of the price and the quantity used, and so what's driving that is a greater quantity. and what we've seen is larger holdings of livestock inventories.
Okay. Can you compare farm sector equity to now, I guess, compared to the 1980s? How does it compare?
Okay, let me, I think the best thing I can do is bring up the slide for the question.
Yeah, that's a good idea.
So equity, so in the late 70s and early 80s, we did see a large run-up in equity. So this is driven, and these are in real terms. These dollars are in real terms, so this is inflation adjusted. So we do see, so if you can, as you can see, we are higher in terms of equity now, but the late 70s, early 80s represented a time of relatively high equity, and this was based on land values. So as you can see, the debt wasn't too much higher then.
Okay. Somebody has a question about slide number 24, I guess, the key reference data, I guess it is. The farm income plus the off-farm income doesn't seem to equal household income. Can you explain that? Is there some other element that's not there?
That's right. Those two won't add together. Farm income plus off-farm income won't add. These are medians. So some farms don't have zero farm income. Some farms have, in some years, have zero off-farm income. So these are just the medians, and so they won't add to total household income.
Okay. In terms of the operation expenses for labor costs, which indicator do you use to forecast labor costs?
Yeah, we do use an employment cost index, so for wages and salaries.
Okay. Let's see. There's another question. Hold on one second. Under higher, hang on one second. Did the recession affect farm income at all?
So actually, during 2008 and 2009, we started to see net farm income increase. So as well through 2010, 2011, 2012. So it didn't bring. The answer was it didn't. The recession didn't bring down sector income, and in fact, it was the run-up was driven more by factors in the market on the ground.
Okay. The strong Midwest crop yields this year seem to have affected your updated figures. Is that the case, or is it something else?
Yeah, that is the case. So there was a revision for crops. So let me go back to the I think what was the first slide here, and show you the difference between August and November. So this was represent what new information we have for the 2015 forecast. Like I said, we had new WASDE prices, so we're using the November WASDE release, and there were significant revisions to prices that affected cash crop receipts, and among them would be soybeans. So we saw a large change, or a change in the quantity, and that's what's affecting the Midwest in particular.
Okay, another question. Are larger farm businesses, the ones that have with $350,000 or greater income, are they doing better than the smaller farm businesses?
Okay, let me bring up the. I don't know what the definition of smaller farm business would be. So I guess I guess I don't have an answer for that. So.
Okay, we can get an answer for that person. Let's see. Of the proportion of farms that have shown sharp increases in debt to assets, the ratio in recent years, do you have any information about what types of farms are seeing the most pressure?
We're working on that, but we don't have something that we can present right now.
Okay. What uncertainties still exist in the 2016 forecast?
Okay, so the 2016 forecast will still rely on new updated information that we'll get in 2017 on how farmers had marketed their 2016 crops, so the 2016-2017 marketing year. So we'll better know how much of the crop was marketed in 2016 versus 2017. So we'll see. We might see some movement in the marketing patterns, and that could drive that could change the net farm income number.
And how has the downturn in farm income affected rural America?
Well, I think overall the effect would be small in rural America. However, there are probably more than 400 counties that we would call farming dependent, so that the majority of income and employment would be from farming. So those counties would be affected, negatively affected. So while if we consider rural America as a whole, the effect would be dispersed. There are many counties out there that still would be quite affected.
Okay. Jim, that's all the questions that we have. If anybody wants to view this presentation again, it is being recorded, and it will be closed captioned and posted on our website at the URL I put in the chat feature, which is www.ers.usda.gov/multimedia. And thank you very much, Jim, for doing this webinar today. And thank you all for joining us, and have a great day.
Thank you.